Life insurance riders exposed, the only ones worth paying for. If you add every rider your insurance agent suggests, your $30 policy quietly becomes $75 a month. And here's the worst part. Most of those riders, you will never use them, and you don't even need them. Today, we're breaking down which riders are actually valuable, which ones are emotional upsells, and which ones are straight-up money drains. By the end of this video, you'll know exactly what to add and what to reject without guilt. Let's start with the biggest mistake people make. A life insurance rider is basically an add-on. Your base policy is simple. You pay premiums, and if you pass away, your beneficiaries receive the death benefit. A rider modifies that contract. Think of it like optional features on a car: heated seats, extended warranty, premium sound system. Some are useful. Some are marketing. Insurance companies love riders because they increase premiums, they increase profit margins, and they sound protective. But protection isn't always value. So let's break them down one by one. First, the Waiver of Premium Rider. This one is powerful. If you become disabled and can't work, the insurance company waives your premiums. Your policy stays active. You don't pay. Why this matters is simple. The biggest risk isn't dying, it's losing income. In the United States and the United Kingdom especially, disability is statistically more likely before retirement than early death. Without this rider, you become disabled, you stop earning, you can't pay premiums, and your policy lapses. With it, your coverage continues. So who should strongly consider it? Primary income earners, anyone in physically demanding jobs, and self-employed individuals. If you already have solid long-term disability insurance, it's less critical, but it's still worth evaluating. The verdict is that this one is often worth it, especially if the premiums are reasonable. Next is the Accelerated Death Benefit Rider. This one sounds dramatic. If you're diagnosed with a terminal illness, you can access part of your death benefit early to cover medical bills, hospice, and end-of-life expenses. Here's the key. In many modern policies in the United States, Canada, and Australia, this rider is already included for free. So always check before you pay extra. When is it valuable? If you don't have strong liquid savings, or if healthcare costs could be catastrophic, but if you already have substantial emergency savings and strong health insurance, it becomes less critical. The verdict here is simple. It's good if it's free, but don't overpay for it. Now let's talk about the Child Term Rider. This is where emotions start selling policies. A Child Term Rider adds small coverage for your children. It's cheap, maybe $5 to $10 per month. Sounds harmless. But here's the uncomfortable truth. Life insurance is meant to replace income. Children don't produce income. The main financial risk from losing a child is funeral costs, which most families could cover from savings. And when your child becomes an adult, they should get their own policy. So why do agents push this rider? Because it's an easy emotional upsell. There is one exception. If your child has a serious medical condition that could make them uninsurable later, this rider might guarantee future insurability. Otherwise, the verdict is that it's usually unnecessary. This one is an emotional decision, not a financial one. Now let's look at the return of Premium Rider, which is probably the most misunderstood rider of all. This one sounds amazing. If you don't die during the term, you get all your money back. It sounds like free insurance, but it's not. Here's what really happens. You pay dramatically higher premiums, often 2 to 3 times more. You're basically overpaying for insurance so they can refund your own money later. If instead you buy a normal term policy and invest the difference in index funds, in most cases you come out ahead. This rider appeals to loss aversion. People hate the feeling of wasting premiums. But insurance isn't an investment, it's protection. So the verdict here is that this rider is usually not worth it. Mathematically, it's weak for most people. Now let's talk about the Guaranteed Insurability Rider. This one is actually interesting. It allows you to increase coverage later without new medical underwriting. Why does that matter? Because if you're young and healthy now, but you expect marriage, kids, higher income, or business loans in the future, this rider can lock in flexibility. It's especially valuable in countries like the United States, Canada, and the United Kingdom, where medical underwriting can become strict. The downside is that it costs extra, and not everyone ends up using it. So the verdict is that it's good for young professionals with rising income, but less important if you already bought enough coverage up front. Now here's the big picture rule. Ask yourself one simple question. Does this rider protect against a real financial risk? If the answer is yes, then consider it. If it's emotional or it just feels good, skip it. Insurance should protect income, dependents, and debt obligations, not fear. Here's the uncomfortable truth. Most people don't buy bad policies. They buy good policies that are overloaded with unnecessary riders. And that's how premiums quietly double. So if you're reviewing a policy right now, pause before signing. And if you want the next step, watch the next video. Term versus whole life, and which one actually builds wealth. Because choosing the wrong type of policy costs far more than any rider ever will.